So January, month on month, producer prices increase faster than expected. Comparing the core PPI and the headline one, you'll see that core, which excludes food and energy prices, is higher. This shows that inflation is mostly in services. The problem with this is, services inflation is usually less volatile because it's closely tied to salary in long-term contracts like rent, both residential and commercial. Then, healthcare and education. This makes it harder to reduce the inflation. So, on year-on-year numbers, the headline PPI is almost 3% at 2.9%. Core is much higher at 3.6%. So again, this shows that inflation is mostly in services, and both figures are way above Fed's 2% target. And because of this, you see the stock market moved lower by a little, simply because of how sensitive markets are to interest rate cuts. The rise in prices mostly came from professional and commercial equipment wholesaling. Trade services also surged. And so these are the reasons why economists are worried about Trump's tariffs slowly creeping into the overall inflation numbers. And these numbers will very likely keep Fed cautious all the way to their July's meeting. Looking at a more meaningful probability of interest rate cut, at least 60% and more. At the chart on the right, we're looking at 74% chance of easing, which will likely happen in end July's Fed meeting. The U.S. Supreme Court ruling on Trump's IEEPA tariffs is still ongoing. Trade attorneys and custom experts said it's approximately about 300,000 shippers who paid for the tariffs, and it sums up to about $175 billion in potential refunds. Many companies have sued Trump administration. The biggest one is FedEx. So the Supreme Court gave Trump administration, the government, about a month to decide on next steps. So Magnificent 7 Q4 earnings growth, very healthy percentage. 86% of Magnificent 7 companies reported positive earnings per share surprise. When you look at all 500 companies, the number is 73%. Zooming into Magnificent 7, earnings of these 7 exceeded estimates by 5.5%. And looking at all 500 companies, it's 6.8%. Year on year, Magnificent 7's 2025 Q4 to 2024 Q4 actual earnings grew at 27.2%, a very high figure. And that's the 10th time over the past 11 quarters that these 7 companies reported earnings growth more than 25%. When you look at the remaining 493 companies, the Q4 year-on-year growth rate was slightly under 10%, at 9.8%. This has been the trend Q4 2024 to Q4 2025. The blue bars are Magnificent 7. Green ones are the remaining 493 companies. All is still looking quite decent. 3 out of the Magnificent 7 companies, NVIDIA, Alphabet, and Microsoft, are the top 5 contributors for Q4 growth in S&P 500. The other 2 companies are not in Magnificent 7. They're Boeing and GE Vernova. But these 2 had a big jump because of infrequent events. Boeing sold its digital aviation solution business and benefited with $10 billion gains. GE Vernova benefited from tax benefit, close to $3 billion. Look at their earnings trend in the chart on the right. Boeing's was at negative. This point highlights that big tech companies are still maintaining their figures well, and they're very heavy-weighted in the entire S&P 500 index and also in U.S. market. These are the items to look out for. Typically, analysts' estimates are slightly lower than the actual figures. Analysts now expect double-digit earnings for both groups. For Magnificent 7, which is estimated to be 23+%, and the remaining 493 companies to be close to 12%. This is for the whole calendar year 2026. This paints a very positive, forward-looking scenario. On to Germany, the headline inflation fell to 1.9%. Look at the chart on the right. Since last year, February, inflation figures have been hovering at 2% and above, and now it finally dropped to below 2%, which is European Central Bank's target. The drop in the recent inflation is because of lower prices in food and energy prices. The government stepped in to reduce energy costs for companies that consumes high energy. But take note, the recent bombings in Israel and Iran will push oil prices higher, which might affect energy prices. So then, this trend might not hold. Other than in the rise in oil prices, another problem is Trump's Section 122 150 days new tariffs. But anyway, bottom line is European Central Bank still feels there's no imminent threat that the euro area is still in a good place. China's consumer market is recovering. This will likely spell there won't be any large-scale stimulus from the government. Very likely, policymakers will build on this current momentum with targeted, incremental easing rather than large-scale one. This is a very good point from Bruce Pung here. The key for consumer consumption recovery is confidence in income and employment prospects, rather than giving promotions and voucher for short-term easing. A little bit of a background in contrast. U.S. typically hand out cash to consumers, but for China, they use trade-in programs and vouchers, a little bit like Singapore, and the Chinese government's issued about $300 million in vouchers and subsidies so far. It's good to see that these are translating to short-term recovery in consumption. So then, government officials have been emphasizing that they want to boost consumers' income. The details will be announced very soon this week. U.S. and Israel launched attacks on Iran. Other than the capital Tehran, these areas on the right picture are being targeted. Then, Iran retaliated by attacking Israel and Gulf countries that host U.S. military bases, including UAE, Qatar, Kuwait, and Saudi Arabia. Dubai's luxury hotel Fairmont, an international airport, also got affected. On the end of February, Israel and the U.S. launched coordinated strikes inside Iran, and that killed Iran's supreme leader. And so obviously Iran retaliated, and more of this might drag longer. So how did the markets respond? Obviously, safe haven assets picked up, gold and silver picked up. Then, typically risk assets will pull back. These are the indexes. And crude oil also will jump. Every time there's bombings, traders and companies will want to hedge into oil because of the concerns and worries of oil supply disruptions. U.S. crude rose about 8%, and the benchmark Brent increased about 9%. Me personally, I'll pick going more into precious metal because oil typically tend to be more volatile and can be speculative. Gold also has one more reason, one more support factor, which is geopolitical tensions and the uncertainties in U.S. policies. Being a safe haven asset, gold tends to have more factors for support and price. This is a fund that I'm personally invested in. Instead of investing into equities of companies that have activities related to precious metal, go directly into this fund that tracks performance of gold prices. This has one less factor of the company's management and cash flow utilization. This fund tracks London Bullion Market Association gold prices, which has high standards for physical gold bars, at least 99.5% purity. And this is a benchmark recognized by central banks and institutional investors worldwide.